Hi everyone, my name is Deji Adebayo. I'm a financial professional and I work with families, entrepreneurs, and professionals to help them build and protect long-term wealth. A big part of what I focus on is helping people understand strategies that most people will never thought about money, especially how to grow money efficiently while maintaining access to it. Today, I want to show you a concept that a lot of people are starting to talk about, but very few people really understand. It's a strategy that can potentially create tax advantage cash flow that you can use for almost anything you want without early withdrawal penalties, market losses, and without having to save extra money beyond what you're already saving. Now, notice what I said. I didn't say you don't have to save money. I said you don't have to save extra money. What many people do is simply reposition money they're already saving into an efficient financial structure. And the strategy we're going to talk about today is called an Index Universal Life Policy, commonly known as an IUL. You may have heard of terms like max funded IUL, properly structured IUL, overfunded policy. But what do those actually mean in simple English? Today, I'm going to break that down step by step. First, I'm going to show you what a typical IUL looks like when it's set up the traditional way. Then I'll show you what a max funded IUL looks like, which is designed primarily for cash value accumulation and fully fund a policy in a shorter period of time. Now, just because you fund it faster doesn't always mean you should. Like most financial professionals, the principle is simple. The more you put in, the more potential growth you can create. But the most important factor is how the policy is structured. Because if it's structured incorrectly, the result can look completely different. And that's exactly why it's important for both consumers and financial professionals to understand how these policies actually. So let's start with the foundation. What you're looking at here is called a life insurance illustration. An illustration is basically a projection that shows what a policy could look like over time based on different assumptions. It factors in the money going into the policy, the cost of insurance, potential interest crediting, and any money that might be borrowed later. Now, an illustration is not a guarantee of exact results, but it gives you and us a very helpful preview of how the policy might perform over time. Now, the first things we see are the basics about the policy owner. Things like age, health rating, tobacco or non-tobacco status. These factors help determine the death benefit amount of the policy. In this example, we're using a 500,000 death benefit policy. Now, while the death benefit is important, when we design a policy specifically for cash accumulation, we structure it differently than a traditional life insurance policy. The goal is to minimize the insurance cost and maximize the cash value growth. That's what a properly structured IUL different from a typical policy. Now, we look at the premium. One of the most common questions I get is, how much should someone put in into a policy like this? Now, this policy was structured for me. I'm 37 years old, and I just use myself as an example. The death benefit here is right here. It's 500,000, just like I said before. The surrender value right here, this is what I call the available balance. This is what you can actually withdraw. And as you can see, it's zero right now, which means on the first year of the policy, you cannot withdraw any funds. because of the way the IUL is structured. Now, the premium for this policy is $12,000. The policy will be funded for 30 years. And for those 30 years, the client will pay $1,000 every month, or probably $12,000 annually, depending on how the client wants to pay. And for example, this policy I structured it for me, and this is something I actually have. So I pay $1,000 every month for this policy. And by the time I get to age 67, that will be 30 years, I'll stop funding the policy, and the policy will start paying me income. Now, if you want a policy like this, you can start with an amount that, you can consistently save without stressing, your finances. For some people, that could be like $300 a month, or maybe $500 a month, or $1,000 a month or more. The goal is to start with something that makes you feel comfortable and sustainable. Now, one of the features that makes an L unique is the growth. Works. These policies typically have what's called a floor and a cap. The floor is usually 0%, which means if the market has a negative year, you don't lose money due to market losses. Your account simply credits zero for that period. Then there's a cap rate, which may be somewhere around 8 to 10% depending on the carrier and strategy. So the returns fall somewhere between zero and the cap. That's why some advisors say zero is your hero. Because even during difficult market years, your account does not go backwards due to market volatility. Now, when we look at an illustration, the insurance company typically shows multiple projections. One column shows the worst case scenario. This assumes the policy ends 0% every single year, and that's the insurance company's charges the maximum possible insurance costs allowed by the contract. This scenario is extremely unlikely, but it's shown because this is a regulated financial contract. Another column might show a very conservative rate around 3 to 4%. And then another projection reflects more realistic historical averages, which is an average of about 7 to 10%, depending on what indexes you use. But based on historical averages, the IUL does about an average of 7% every year. This helps us understand how the policy might perform under different economic conditions, depending on what happens in the economy. Right now we're talking about tariffs, situations in the world. Things like that could make the economy go back and forth. But now, here where things get really interesting. Once the policy builds sufficient cash value, the policyholder can begin accessing that money through policy loans. These loans can potentially be used for things like maybe you want to start investing in a business. Maybe you have a real estate opportunity that came up. There's a property you want to buy, or any major purchases, maybe even emergencies, or you can use it for your retirement income. And because the money is borrowed from the policy rather than withdrawn, it can also be structured in a tax advantage way. So instead of just saving in a traditional account where access may create taxes or penalties, you're building a system where your money can grow, remain protected from market losses, and still be available when opportunities arise. That's the real concept behind properly structured IRA strategies. Now, let me show you how this policy works for me. I funded this policy for 30 years, So by the age of 66, right here, I would have put in $360,000 into the policy. And by that time, the policy's benefit is about 900,000. That's the available balance. And the debt benefit is about $1.2 million. And I instructed this policy to pay me $50,000 in retirement income every year. That's about. And this is going to pay me for at least 30 years till I am 96. And by 96, we only put in $360,000 into the policy. I withdrew over $1.5 million in retirement income, tax-free. And the policy still has about $1.3 million in cash value in it. And the death benefit, if something happens to me, my family will still get $1.5 million and a transfer of wealth. So this is great. This is a no-brainer. Now, this policy is not really max funded for maximum cash value. I have another example of a policy that's max funded in 3 years and is max funded for cash value where you can access the cash immediately. I'll show you what I'm talking about. So, this policy right here was only funded for 3 years. And you notice the debt benefit is only $179,000. And on the first year, I can access the policy via loan immediately. Almost 90% of the policy, the premium is available to me. So I can withdraw $11,000 that same year. This is a properly structured policy for max funded cash, which means I can put in $12,000, borrow $11,000, and the policy is still growing like I did borrow it. Because the way it works is the insurance company borrows you that $11,000 and they leave the remaining money in your account and it's still growing over time. Plus, you don't have to pay back. Why? Because God forbid something happens to you, there's still a death benefit. That's your collateral right there. If something happens to you, you can't pay back, the insurance company is just going to deduct the money from your death benefit. Isn't that great? This is what we call infinite banking, where you can put your income in the life insurance policy, take out some of that money for expenses, and you don't have to pay it back. So now, this policy was max funded for only 3 years. At the end of max funding, we only put in $36,000. And if we didn't withdraw any money in this policy by the age of 96, this policy would have grown to $1 million. And we only put $36,000 into the policy. Isn't that great? This is where people that understand the value of strategies like this is how they make money. And this is a no-brainer. I think everyone should have this, right? Plus, if you'd like to see how this might work for you, personal situation, I'm happy to walk you through it. We can run a custom illustration based on your goals and your income and your timeline too. Because when structured correctly, these strategies can become powerful and be part of your long-term wealth plan and your family. If you think this is a good strategy for you, just send me a comment down below and I'll contact you and we can work something out. Thank you.
Bye bye.